Hey guys, and welcome to this video. In this one, we're going to talk about trends, how they form, why they form, and really more or less how you should trade them. So I've just got a simple chart up here with a grid background, and I've just chucked 20, 40, 100, and 200 moving averages on there just to help a little bit with price tracking. I'm actually going to flick to the monthly at this point. So on the monthly chart at the moment, you can see you've really got a fall, and I did this a lot on TradingView where I post most of my analysis, but you've got a fall from up here down to here. And, you've got this push up, you hit some previous price action, and we look short here, and you've got this fall coming. Now, if you swap to the weekly, of course, it elongates a bit more, and you can actually see how this trend is developing. So you've got a point here, a point here, a point here, and a point here. Now, on the monthly, if this were to continue much lower, okay, it might look a little bit different, and obviously the trend would be further extended. So when you drop your time frames lower, it elongates, obviously because there's more periods, but it shows you how that trend is taking place within those monthly candles. Now, the reason why this happens is simple, and a lot of traders don't get this, and that's, of course, why I'm doing this video. When prices come down, okay, so we obviously had a lot of financial news come at this point that didn't make traders very happy. Um, mainly due to inflation and things like that, people having less money to spend, it slows down economies, companies make less money, and people start to short equity markets and pull their money out of investments. So the price comes down. Of course, we then see a push up. Now, you'll notice on most of these pushes up, it comes with some minor positive market sentiment. Now, what makes the overall downtrend is two things, and it's really important to always remember this when you're trading. And again, that's more or less why I've done the video. The move from this point to where we are now, okay, coming up to halfway, just over halfway through December, has underlying bad market sentiment. And reason why I say underlying sentiment is because we always know throughout this move that the sentiment, even if we get these positive little pumps in between, is bad. So we can infer that there could be room for a much lower move, especially as we'd seen such a massive rise after COVID, because people then had a boom after they saved all that money and the price comes up. But you will notice there's little dips in that move as well. Okay, but we knew the overlying market sentiment was positive to the upside. So any of that minor bad news, we could treat very lightly. So remember, guys, there's always an underlying market sentiment, and as long as you know what that is, you'll get a better gauge for how far the market could fall. And even if you do get these positive outbursts, okay, you'll then be able to measure your risk accordingly because you're going to know how far along that trend you are and how harsh that underlying market sentiment is, whether it's really bad or really good in either way. If you haven't understood what market sentiment is, please watch my previous videos or find me on TradingView for updates on that. Thanks for watching, guys. Hope that helps. See you in the next one.